Ford has around $130 billion in debt. That's quite a lot of debt for a company that needs to move away from manufacturing gasoline-powered cars to manufacturing electric cars. And you know what? Even if they were making only electric cars, it's still a lot of debt. I mean, rivals such as Tesla have around $2 billion of debt and $22 billion of cash on hand, meaning they could pay off their debt and still be plus $20 billion. So is Ford's $130 billion a cause for concern? Should we be worried about Ford's ability to actually pay back that debt, and could they go bankrupt by the end of the decade? Hello, my friends. Welcome to the channel. I'm the Electric Viking. My name's Sam Evans and I'm coming to you from Melbourne in Australia. And I have a very definitive answer to this question, which I'm sure some of you have been wondering about. Today, Ford celebrated manufacturing 150,000 Mustang Mach-E's. It's still a minuscule percentage of their overall production at the moment, meaning EVs still make up a small percentage of the company's vehicle sales. However, they tweeted this and Elon Musk tweeted, "Congratulations, Ford." It seems as though Jim Farley and Elon Musk have a pretty healthy respect for each other. I think Jim Farley is doing some of the right things, but he has inherited a lot of debt. And the debt portion of a company is often a hot topic. The reason is that debt is usually the main cause of bankruptcy for most companies. NIO, electric car company, not many people realize they declared bankruptcy a few years ago. Now, I think they probably potentially will again within the next 5 years. Moving on, this is about Ford. It's no exception for the Ford Motor Company, and we should definitely look at their debt. If Ford carries too much debt and the risk of default is imminent, the company may need to take some drastic actions, including debt restructuring and asset disposal. Now, another company that's gone bankrupt, or basically essentially gone bankrupt, is General Motors, only about 14 years ago. So let's look at Ford's total debt, its net debt, and break down that debt. Ford's total debt has been mostly flat in the last 6 years, except for the period in fiscal 2020, in which the company significantly racked up debt to maintain liquidity when the COVID-19 pandemic first hit. As of fiscal second quarter 2022, Ford's total debt came in at $129 billion US, down roughly 12% from a year ago, and was the lowest since fiscal 2020. But that said, it's still a lot of debt for a company who's not making a product, primarily not making a product that customers will be buying in the future. I mean, think about it. Basically right now, 95% of Ford's production is making these, when clearly these are not the future. So it's going to be challenging for Ford to continue to invest and then move away from its crack habit right now. I mean, all automotive companies are basically addicted to making money from selling gasoline-powered vehicles, which they won't be able to do in 10 years' time, or maybe in 5 years' time. To find out what makes Ford's total debt, let's look at the debt breakdown as shown in the chart. According to this chart, Ford's total debt comes from two segments, Ford Automotive and Ford Credit. Very important to consider that not all of Ford's debt comes from the automotive area. Ford's automotive segment is also referred to as the total company excluding Ford Credit and consists of all subsidiaries other than Ford Credit. Now, StockDividendScreener.com says that Ford's credit debt contributes to the biggest portion of the company's total debt, notably at over 80% as of fiscal 2022 Q2. A lot of people are confused by this. In the same quarter, Ford's credit debt totaled $109 billion compared to only $19 billion for the total company excluding Ford Credit. So does this mean then that the Ford's automotive side of the business only has $19 billion worth of debt? Kind of does, actually. Ford's automotive debt increased significantly during 2020 by more than 100% and reached nearly $40 billion in the second quarter of 2020. Prior to 2020, Ford's automotive debt averaged only $15 billion, a far lower figure compared to the elevated figure reported in fiscal 2020. When the COVID-19 pandemic first arrived, Ford Automotive drew on cash from the credit facilities and took on an additional $8 billion in debt in the second quarter of 2020, causing automotive debt to rise massively in that same year. The excess cash drawn from credit facilities was meant to help Ford to maintain financial flexibility during the COVID pandemic. By the fourth quarter of 2020, Ford has repaid most of the debt drawn from its credit facilities, and the debt figure reached only $19 billion as of the second quarter of 2022. That's a decrease of 27% from 1 year ago. This is actually a pretty impressive result considering the fact that Ford is paying huge amounts of money through car warranties. In fact, it pays more for car warranties than any other car company in the world except for Volkswagen, and it pays about double the amount in warranty costs per year compared to General Motors. This is a significant problem for the company, and it's an issue Jim Farley has mentioned on numerous occasions that Ford needs to address urgently. On the flip side, Ford's credit debt decreased significantly during 2020 and reached $133 billion by 2020 Q3, well below its historical high. By the second quarter of 2022, Ford Credit's debt had further declined to $109 billion, down 12% from a year ago. Prior to 2020, Ford credit debt averaged around $140 billion and had actually been on a rise since 2017. That means that Ford's credit debt is at its lowest level of the last 30 years right now. The decline in Ford's credit debt in fiscal 2020 and further in fiscal 2021 can be attributed to the fact that Ford Credit runs on a completely different business model from Ford's automotive division. Ford Credit is the captive finance arm of Ford Motor Company, providing financial services such as lending and lending services to wholesalers as well as retail customers. So this debt is essentially loans from people and companies that Ford gives out to those people. During the age of COVID-19, Ford Credit expected a reduction in lending and leasing activities, and it projected to decrease the size of its balance sheet and funding requirements in 2020. This was a form of risk mitigation. What this means is that Ford Credit's debt has increased during a good economic cycle. So when things are going well, Ford will lend more money out. However, when things are not going as well, the debt will decrease when the automotive business environment deteriorates, as there will be fewer customers signing up for Ford Credit's leasing contracts. So is the decline in Ford's credit debt a piece of bad news for the investors, as the firm is originating fewer loans? To figure this out, we have to look precisely at the portion of Ford Credit's debt that has declined the most. Ford's credit debt is made up of three major categories, which are short-term loans, unsecured debt, and asset-backed debt. As the name implies, short-term loans are current debt and are to be paid back within a single year. Unsecured debt can be both short and long-term, but they are unsecured and do not need collateral for the borrowings. However, asset-backed debt is a type of secured loan and is repaid only from cash collected from securitized assets. As you can see from this spreadsheet, the assets portion of Ford's debt is much greater than the liability portion of the asset-backed debt. As a result, Ford's credit asset-backed loans are usually quite safe in the sense that the assets that support these loans are readily available. However, if there was a significant economic downturn, things could turn for the worse, as a lot of these loans may not be able to be paid back. Unlike unsecured loans, Ford Credit's asset-backed loans are repaid only from cash generated from the respective assets, i.e. finance, receivables, and operating leases. This means Ford needs to use the cash generated from business operations to repay the unsecured loans. According to this chart, Ford Credit's asset-backed debt totaled around $46 billion in the second quarter of 2022. This constitutes around 36% of Ford Credit's total debt. While asset-backed debt has declined, Ford Credit's unsecured loans and short-term loans have declined at a much faster rate. As in fiscal Q2 2022, Ford Credit's unsecured debt totaled only $50 billion. That's the lowest level that it has ever been reported since fiscal 2017, while short-term debt came in at only $14 billion, lower than its historical highs. On a long-term basis, both of these loans have been on a decline, meaning that Ford Credit has been deleveraging itself of all of this unsecured debt. Ford's net debt is calculated by having Ford's unsecured debt deducting the company's cash and cash equivalents as well as marketable securities, as shown in the following equation. Ford's net debt equals unsecured debt minus cash minus marketable securities. Unsecured debt consists of the portions from Ford Automotive and Ford Credit excluding asset-backed loans. StockDividendScreener.com says marketable securities are included as these are near cash assets that can be converted to cash almost instantly. Ford's net debt averages around $60 billion after accounting for the cash. As of the second quarter 2022, Ford's net debt totaled $47 billion, a 22% lower figure than 1 year ago. While a decline in net debt usually bodes well for the company, we still have to look at the leverage ratio. The debt to equity ratio measures Ford's debt leverage from the perspective of net debt against shareholders' equity or book value of the company. As seen from the chart, Ford's net debt to equity ratio rises significantly during fiscal 2020, and the ratio reached a record high at 2.2 times in 2020 first quarter. In subsequent quarters though, Ford's net debt to equity ratio has been on a decline and reached only 1.1 times as of fiscal second quarter 2022. That's the lowest figure ever seen in the last 5 years. And this illustrates that Ford's leverage has been on a decline. At a debt to equity ratio of 1.1 times reported in the latest quarter, Ford's leverage was considered low as the net debt was only slightly higher than equity. For example, Ford's net debt would come to about $1.10 for every $1 of equity. Comparing Ford's debt to equity ratio with General Motors' debt to equity ratio, General Motors' leverage was slightly lower. In the past, Ford's debt leverage was twice as much as General Motors' debt leverage. As of 2022, General Motors' net debt came in at $42 billion and total equity of $68 billion in the same quarter, thereby giving a net debt to equity ratio of only 0.62 times. The debt to asset ratio tells us about Ford's capital structure or debt structure. The capital structure reflects the ratio of Ford's total assets being funded by debt. Ford's debt to asset ratio shows that the company had a ratio of about 60% prior to fiscal 2020. At this ratio, Ford's capital structure was made up of 60% debt and 40% other liabilities as well as equity. However, Ford's debt to asset ratio increased significantly higher to 65% in fiscal 2020 second quarter, driven mainly by the increase in indebtedness during 2020. As of fiscal 2022 Q2, Ford's debt to asset ratio retreated to 52% after Ford repaid most of the borrowings drawn from credit facilities. The result shows that Ford's total debt level has dropped with respect to its assets. From a comparison perspective, General Motors has a much lower debt structure at only 43% as of the second quarter of 2022. Again, Ford's higher debt to asset ratio shows that the company's leverage was much higher than that of General Motors. So the question is Ford using its debt effectively? The total debt to revenue ratio should give us a clue about Ford's debt efficiency. Based on the chart, Ford's total debt to revenue ratio has remained relatively constant at 1 times prior to fiscal 2020 before the arrival of COVID. At this ratio, Ford managed to generate $1 of sales from $1 of debt. However, in fiscal 2020, Ford's debt to revenue went significantly higher and totaled as much as 1.34 times in the second quarter of 2020 before retreating to 1.27 times in the fourth quarter of 2020. A growing debt to revenue ratio indicates either a deteriorating revenue or surging debt for the company. Therefore, these metrics don't bode well for the future health of Ford. Luckily, Ford's total debt to revenue ratio declined in fiscal 2021 and it clocked in at 0.9 times as of fiscal Q2 2022. Basically what this means is COVID was bad for Ford. After COVID, not so bad. An improvement. This ratio was the lowest in the last 6 years and was even lower than the figure recorded prior to the COVID-19 pandemic. The declining ratio means that either Ford's revenue has been surging or the debt has been on a decline. And of course, in this case, we're seeing Ford's debt decrease. Is there a cause for concern for Ford's $129 billion in debt? Well, most of Ford's debt comes from its credit segment. What that means, Ford's credit debt makes up roughly 80% of their total $129 billion in debt. While Ford Credit may seem like it is loaded off with an enormous amount of debt, the fact is that a portion of the debt, 36% to be exact, was originated from lending services provided by Ford Credit. In other words, these are asset-backed loans and are repaid only by cash collected from Ford's securitized assets such as finance receivables and operating leases. The rest of Ford Credit's debt is unsecured loans and has to be paid back by cash generated from business operations. Therefore, that debt, which is a high percentage of Ford's credit debt, is actually more risky. So people saying that because Ford's debt, the majority of it is credit debt, is actually a good thing. Well, there is a significant amount of risk involved there because the majority of those loans are unsecured loans. While the majority of Ford's credit debt is unsecured, the company has been reducing its unsecured debt as reflected in the debt breakdown. In addition, Ford's net debt came to about $47 billion as of fiscal Q2 2022 after accounting for cash and marketable securities. At this level of debt, Ford's leverage came to about 0.9 times with respect to equity in fiscal second quarter 2022, and that's the lowest ratio we've ever seen. This level of leverage is low, and it should be, because we're in a period in time where disruption is happening very quickly. However, the good thing to note is this ratio has been on a decline for the last 5 years, and that means Ford has been deleveraging over those 5 years to prepare for the future. Similarly, Ford's automotive debt has also retreated or declined in 2022. Since most of Ford's debt has declined and the leverage ratio also was at its lowest level, there's not a lot of significant concern right now regarding Ford's debt. However, that doesn't take into account the truth and the reality, which is this. Much of Ford's so-called assets, which are included in these metrics, are going to be pretty much useless in the future. What do I mean by that? Well, basically Ford has to retool entire factories or build new factories purpose-made for manufacturing electric vehicles. That will cost money. Well, billions of dollars will have to be written off because essentially all those tools, all those purpose-built factories made to build gasoline-powered cars will be not worthless, but worth much less than what we are factoring in, or at least what the banks are factoring in to Ford's so-called current assets. So while Ford's debt is not a significant concern right now, if the market moves to electrification at a faster rate than what everyone's predicting, then that debt won't look so good in the future, especially if there is a significant recession and those unsecured loans aren't able to be paid back. I'll update you guys in about a year from now on Ford's debt and how it's looking at that time. Right now, it's looking okay. In 12 months or 2 years' time, things could quickly change. Thanks for watching. Let me know your thoughts in the comment section below. Bye-bye.